Hey everyone, this is Richard Yi. Today is September 14th, 2012. The Fed has finally pulled the trigger. 12 days after ECB announced its unlimited bond buying program, the Federal Reserve also yesterday announced that it will buy 40 billions of mortgage-backed security every month until the job market improves. Yesterday, immediately after the announcement, we see the equity market and commodity market soared, with Dow Jones hitting record highs and gold price advanced more than $40. However, in the bonds market, as inflation expectation kicks in, we see the yields on longer-term bonds start rise quite rapidly. The objective of the new QE is obviously to increase aggregate demand through inflating home prices and thus create a wealth effect. However, as the Austrian theory tells us, more government intervention in the economy only creates more problem, and that gives the incentive to the government to create more interventions. And this is what I think about the new QE. Given its nature, I think it's a bailout to those banks who hold mortgage-backed securities. But moreover, I think the new QE is really a gamble. And the key is really the Fed's asset strategy. Let's make up two scenarios. The first one is that the economy actually improves and the unemployment rate goes down. In that sense, the default rate on mortgages are lower, and therefore the value of mortgage-backed securities held by the Fed actually appreciate or doesn't change much, right? In that sense, the Fed actually does have a really valid asset strategy because you can just sell those mortgage-backed securities into the market and perhaps buy back, and then to suck back the liquidity. And our second scenario is really if the economy doesn't improve or even get worse, and which is very likely, by the way, and the unemployment rate goes higher, the mortgage-backed securities the Fed held would be lower because the default rate on those mortgages would be higher. In that sense, when the Fed sees the inflation really kicks in and it wants to suck back liquidity by selling those mortgage-backed securities, it cannot do it because the value of those mortgage-backed securities are lower, so it cannot suck back as much liquidity as it is released in the first place. And given the failure of the previous QEs, we are very likely to know how this one will end. Now I want to briefly talk about the inflationary aspect of the new QE because the new QE is fundamentally different from the previous two. The previous two has limited buying amount by the Federal Reserve, but for the third one, for the QE3, the buying is 40 billion every month till whenever the job market improves. And given the drought condition earlier this year, combining with now the new QE, new unlimited QE, likely that's going to create a huge inflation down the road, and that's devastating to the middle class. And I guess that's everything for today. I'll be blogging again soon, guys. Take care. Bye.